Right, let's get a move on then and connect with our next guest. We've got Amit Sachdeva, who is the Indian equity strategist at HSBC Securities, now joining us on the show to share with us his outlook on the markets. Thanks so much for taking time out. And just earlier this morning, we were alluding to the fact that pretty much all the pieces in the puzzle are together. And this is an extraordinary feat, the fact that global macros, global markets, our own macros, crude, we put it all together, even FIIs have been contributing, are all really working in favor. What is this really painting a picture for the year ahead?
Hi, good morning, everyone. Thank you so much for having me here. I think I recall our conversation a month back, I guess, when market was in a correction mode, and I was calling we are middle of a large bull run, if you recall. And I think the reason is that the factors that shape India's strong bull runs are coming together all at the same time and become favorable. That happens very rarely. So I think this is one such phase which is very decisive. And when it sets in, it doesn't go away that easily. You may have short-term phases of profit booking with events such as US bond yields rising or even crude spiking in the meantime. But the moment there's a little correction there, you've seen US bond yields now sub 4% and crude has come back to 70. And the rest of the outlook was already very positive. So I see the 10-factor model that we have, which sort of predicts in a way that how bullish we should be. I think 9 out of 10 are so favorably placed. And I think we should expect, as we enter the new year, very decisive bullish phase to set in. And we have obviously election year this time as well, which would have its own volatility and its implication in the market, but that for another point. But at the same time, the factors that shape earnings, valuations, FIs, base of flows to Indian macro, external environment, all coming together for that Indian market could be in a very decisively positive phase. So we remain very bullish. India is a key overweight market for HSBC, and we continue to like India a lot.
How much of the good news is in the price? Well, it's perfect and all stars have aligned, but they say in market, you don't make money when there is cheery consensus. We are at a stage of cheery consensus and markets are at record high. Valuations are at a record high. So one is buying stocks now or holding stocks now. Do you think in next 1 year, are we likely to get double-digit returns, single-digit returns or no return?
Well, that's a great question, Nikunj, and I would probably hazard a guess like this, right? There are obviously two parts of the market. One is the large cap space and there's a mid and small cap space. And if you look at, there's a clear divergence there. If you look at valuation point of view, I think we are in the large cap space has already moved, right? It's valuations are really 5-year average. It's a mid and small cap space, which is leading the charge in this rally, which is a typical of bull runs. If you look at last bull runs, we have small and large, small and mid caps tend to rally 1.4 times the market run. We are at now 1.8, which is, I think, is a symptom of that market has also realized that identifying those small and mid caps, which are potential large caps. And this is a perfect phases of market where market tends to become risk on and bets on those stocks. And that is very typical for bull market risk taking. And 30 to 40% or number can vary, but these stocks tends to become large and become compounding stories. So for investors, the quest is to find those mid caps or small cap, for example, that can display that characteristic. But in the meantime, we'll also see that rotation keep happening to even some of the left out great quality names, which have not performed in the rally, and FI flows come back. We could see up move there. And by the time mid cap space can also still become a breather, take a breather and then come back. I think we see about double-digit return again in the market. But there is a variable here this year, Nikunj, is that political outcomes would also be a determinant of how markets behave. For example, with a 3-state win recently, obviously markets attaching higher probability of political continuity. And if that's the case, the probabilities continue to strengthen as we go along. Market would see more decisive bull runs because there's a political certainty, macro looks good, and that's a key to shaping next 5 to 10 years for India as well. But if there was an adverse outcome, for example, and that's a key risk for the market because market would then tend to correct. And then as history tells us that, after that correction, market would take a breather and then recover again. So in that case, market probably could be flat in the year. But if political continuity is assumed, then we are looking at a strong double-digit return in the market again, because it's purely earnings-led, and we have many factors of the market have not yet participated. So we see the bull market would benefit all the aspects of it. While I would also stress out one point, that large caps tend to underperform in the entirety of bull run. So you will see mid cap and small caps tend to find much more momentum as the bull run continues to deepen. But one thing is for sure, we are still in the middle of bull run, and bull runs once set in tends to have a momentum which can last up to 3 years as well. And we are still far away from here.
Quite a few takeaways in there, Amit. But first things first, what will the FI money chase? Would it be the undervalued large caps? Because, size is a compulsion with them.
Sure. So, no, it's a great question. And I think if you see the last September and October, we saw a significant outflow by FIs, about 5.5 billion. In November, we've seen uptick again. In December is uptick again. But my sense is that the way all the factors that influence FI money into India, they are back in favor and favorably placed. So I see FI flows continue to strengthen now, which has already become positive, by the way. So it is clear that FIs tends to, like size and liquidity and several constraints that come with that money. So it imminently will benefit some of the large caps, which are, seen as winning business models, but have lagged, and that mean reversion could happen for them. So some amount of, immediate uplift could happen there, because I believe FI flows are imminently due, which has already started to happen. And as the year begins, I expect a strong rebound in FI flows.
Samit, while election outcome is important, I endorse that. Valuations are a bit stretched. Now, what should one do then? I mean, if election outcome is not bad, markets could be down 10%, 15%, 20%. That's anyone's guess. The point is, how do we take care of that in terms of bulletproofing the portfolio returns? What should one do in terms of maximizing the gains and protecting the gains?
Nikunj, obviously portfolio managers are very adept at, taking a broader balanced view. But my sense is that 3 or 4 kind of stocks that you could decipher as a sector radars also sort of breaks it down, where the momentum is very high. Valuations are slightly richer, investors are optimistic, but business dynamics are also very, very positive. Right? There are many sectors. Real estate is one of them. Autos could be another. So you'll see that sort of momentum carries on, and interest rates will also help some of these sectors as well. So in some sense, those are momentum sectors that must be played, right? And selectively, of course, there could be pockets of excesses you can avoid, but there's opposite to that would be sectors which are beaten, where the investors are pessimistic and business dynamics are also negative, right? Say IT would qualify there, which we have seen. Now, when the market is in a risk-on mode, market is taking risk with a one-year view. For example, some of these names would tend to rally, in this market. So one has to also take some of the stocks which are in the risk-on context as well, where the stocks has got hammered in the past cycles, and then this market momentum can help those stocks also recover. So blend with that. And the third would be where, I would say that business dynamics could change for positive, but investors are negative, where large cap banks would sit in that category, for example. So you would blend some of those as well, ideas where you could escape buying expensive valuation, but some sort of mean reversion could play as well. And then avoid some of these names where valuations are run up a lot and business dynamics could turn negative. In these markets, you could see some of these names not perform. So I think blending the three, some risk on, some momentum, and some winning aspects of the businesses, blending the three would be a great idea. And then take a cautious view of names which are excessively valued. So some cautions definitely required, not buying all what has run up and paying all the momentum, but taking a balanced view in this market would help protect people from any major hard landings.
Interesting. So let's delve a little deeper in there, Amit, because, what is overvalued and what's not, that definition is getting a little bit blurry looking at growth and the prices on the screen.
Well, I would probably reserve myself comment to purely at the sector level, with there's a restriction that we are on, but at the same time, I would probably think that in our case, real estate looks on balance looks very good, which blends business dynamics as well as valuations and all the rest of it. So that one sector we really like in that context. Even autos will continue to support a little bit, right? Retailers, I think we also like, because that's some sector which also benefits there. IT, we like very selectively as a risk-on sector, which still qualifies for that. And you avoid, excessive valuations where valuations have reached way above 5-year means, and that risk management is necessary. I'm not getting into stock specific details here, and people can figure that out. But I feel that, when the bull market is happening, market is buying risk, but also market is buying momentum, right? And then market is buying little bit of some of the avoided names as well. Turn by turn, that could happen. So that said, I feel that 5-6 sectors still look good to us, which includes banks, of course.
But isn't bank a crowded trade? I mean, most of the funds are 30-35% overweight on banks. The fact that banks will do very well is more like a ghar ghar ki kahani. Banks are exhibiting strong growth. Everyone knows that. So where is the upside for banks? I mean, either fresh buyers have to come, or some extraordinary triggers have to come, which perhaps may not be true for banks.
My sense is a more mean reversion trade, to be honest, Nikunj, because last year some of the banks have completely missed the rally, and valuations become quite valuable. And then those are the times where you choose some of the avoided names as well. I'm not really going to stock specific name, but you can guess that, right? And so those names can see reasonable mean reversion as the year begins, where the ideas run out on the other side. You could see some of those moments, very, very easy gains can come. Not 50%, but very reasonable gains can be predicted there.
Outlook then, Amit, when it comes to the entire earnings, given that there have been certain pockets that disappointed in the previous quarter, what does the next year ahead hold in terms of profit growth, revenue projections, etc.?
In fact, I would probably think that while, every year that begins in India begins with a very large expectations of earnings, and when we enter the year, earnings continue to get cut. This year has been particularly very, anomalous year in that we have not seen much earning downgrades. Like, in fact, even Q2 was seen to be very, a mixed quarter, but we've seen earning upgrades across many sectors. And earnings, in fact, have held to, very reasonable levels throughout the year. And then, next year also, I don't see expectations are crazy. Like, for example, Nifty earning expectations will be about 12-13%. This year we are ending at 18. I don't think that 13% expectations are overall basis is crazy. So I'm sense that there could be still upside risk to earning based on how GDP growth and other things settle. But we are not building excessive expectation. Still, India is seen as one of the large growing markets, and inflation being, obviously remaining very, very benign now as we go into the next year. One can hope that earning downgrade risk is also low across sectors. So that paints a good picture, because one thing that obviously holds back market turn in these kind of markets is where the earning downgrades are happening. So we don't see earning downgrade in FY25 because the expectations are not crazy at all. While FY24, if you see, is held up pretty, very strongly, to be honest, across sectors. Barring few, I think we've seen only upgrades rather than downgrades.
Okay, good to have you on board, Amit. Thanks so much for giving us your take as to what lies in store for the markets, as well as your overall outlook in terms of valuations and earnings.